Welcome back, everyone, to a brand new explainer. Today, we're tackling a massive silent portfolio killer. We're talking about the hidden operational costs that slowly but very surely eat away at your hard-earned profit margins. If you've ever looked at your account at the end of the month and felt like the math on your winning trades just wasn't adding up, well, you're definitely in the right place. We're going to break down exactly where that money is leaking out, and far more importantly, how you can keep it in your pocket. So let's start with a quick question. Why is it that the literal second you hit the buy button, your P&L instantly flashes red? You're automatically down right out of the gate. Look, it's not a glitch in the matrix, and your broker isn't conspiring against you. It's just the reality that every single financial transaction carries a hidden operational fee. And this fee? It exists completely independent of whatever commissions or platform fees you're already paying.
In the industry, we call this the friction cost. This basically encompasses the bid-ask spread and slippage. It's the difference between the theoretical price of an asset you're looking at on your screen and the actual real-world price you pay to execute that trade. If you ignore these friction costs, they act exactly like a slow leak in a tire. Over time, they can literally turn a mathematically winning strategy into a losing one, especially if you're an active short-term trader.
Okay, let's actually break this down. The true total cost to play in any market is essentially made up of three slices. You've got your fixed broker commissions, the realized spread, which is the gap between the midpoint and your actual fill price, and then slippage. Now, if you're a scalper, these operational costs might chew up 50% or more of your expected gain. So let's talk about how to beat them. Starting with our first focus, beating the bid-ask spread. Have you ever heard the term market maker tax? When you throw down a market order, you are essentially demanding instant execution. You want in or out right this exact second, and you're paying a premium for that convenience. That tax goes straight into the pockets of the market makers or liquidity providers who are taking on the risk of filling your order instantly. To really visualize this tax, you have to look at the order book like a giant standoff. On one side, you have the bid, that's the demand side, showing the absolute highest price a buyer is willing to pay. On the other side is the ask, the surprise side, showing the lowest price a seller will accept. Now, in any liquid market, these two prices never actually touch. If they did, a trade would trigger instantly and a new gap would just form right behind it. Let's put some real math to this, because this is crucial. $50. That might not sound like a huge deal, but imagine a tiny, innocent-looking 5-cent spread between the bid and the ask. If you drop a standard 1,000 share order at the market, crossing that 5-cent gap means you instantly absorb a $50 unrealized loss. The market literally has to move 5 cents in your favor just for you to break even on the trade. So what's the actionable fix here? Use limit orders. While market orders forcefully cross the spread and pay that convenience tax, a limit order completely flips the script. It prioritizes your price over the speed of the execution. By placing a limit order at the bid, you actually become the liquidity provider. You're forcing the market to come to you, which completely bypasses that market maker tax. Moving right along to our second topic, surviving execution slippage. We've all experienced this extremely frustrating scenario, right? You see the absolutely perfect setup, you smash the execute button, and suddenly you're filled at a price that looks totally wrong. You're left wondering, why did my perfect entry fill miles away from where I clicked? Again, it's not necessarily a bad broker trying to pull a fast one on you. What you're experiencing is slippage. It's just a natural byproduct of your market order colliding with a limit order book that is moving at lightning speed. Now, negative slippage is when you buy higher or sell lower than you expected, which hurts. Positive slippage, which is definitely less common, but it happens, is when the market actually ticks in your favor during the milliseconds it takes your broker to route the order. This dynamic hits the absolute hardest during major economic news. During a normal trading session, that spread width might be a super tight 1 cent. But the second a massive data drop like CPI or non-farm payrolls hits, that spread can explode to 20 cents. Market makers aren't stupid. When volatility spikes, they immediately pull their liquidity and widen the spread just to protect themselves from getting run over. The major takeaway for you? Avoid high volatile windows. Seriously, unless you are a seasoned expert in news trading, do not blindly throw market orders into data drops. That massive instant spread expansion can cause a 1 to 2% drawdown on your account before your trade even has a chance to breathe. It's just not worth it. Real quick, before we get into how big orders actually move the market, you can save $15 right now using our referral link in the description to get the absolute standard in charting with TradingView. Honestly, it is the fastest and most reliable way to follow the markets and track these exact spreads we're talking about today.
All right, let's jump into our third focus, managing market impact.
There's this huge assumption in the retail space that we really need to break right now. Do large orders guarantee an instant fill at a single price? Well, when you're trading one or two micro contracts, sure. But as you scale up and start transitioning to professional sizing, the mechanics of the game completely change. Let's look at how a massive order actually walks the book. Let's say you want to buy 5,000 shares at the market. The current ask is exactly $10. But hey, there are only 1,000 shares sitting there. Your order instantly eats those up, then moves up to the next seller at $10.01 to grab 2,000 more, and finally fills the remainder at $10.03. You just exhausted the best price liquidity and caused your own slippage, leaving you with a really terrible average fill price. So the actionable solution to stop this self-inflicted slippage is absolutely crucial. You have to monitor the level 2, or the DOM, the depth of market. Before you ever drop a large size order, you need to read the DOM data to see exactly how much liquidity is waiting at each price level. You have to anticipate your own market impact before you click buy.
And that brings us to our final section, practical cost reduction.
If you really want to shift from a gambling mindset to a professional, systematic business approach, you need to bake these 5 disciplined rules into your plan. 1. Only trade highly liquid instruments with tight spreads. 2. Use limit orders to force the market to come to you. 3. Avoid massive spread expansions during news drops. 4. Always monitor the DOM so your size doesn't walk the book. And 5. Trade during major global exchange overlaps, like the New York and London overlap when liquidity is at its absolute peak.
Listen, every single cent you save on execution drops straight to your bottom line. And if you're looking for the ultimate blueprint on how to scale your strategies and manage risk like a machine, you need to grab a copy of The Funded Micro, Modern Future Strategies for the Prop Firm Era. It's available right now at franksreport.com, and it dives incredibly deep into the mechanics of everything we've covered today.
I want to wrap up this explainer by leaving you with a thought to really chew on the next time you boot up your platform. When you hit that execution button, ask yourself, are you trading to win or are you just paying to play? Take control of your friction costs, rigorously preserve your capital, and take back your edge. Thanks so much for hanging out and learning with me today, and I'll see you in the next explainer.